Hello, quickly. I want to show you how to analyze stocks, and I look a lot at the oil stocks, and so when you look at the oil stocks, I like to analyze the cash flows and the earnings. And let's get started. So you have in the US you have three large ones. You have the largest in the world, Exxon Mobil. It's integrated. That means they are drilling and looking, searching for oil worldwide and gas. They are also refining, so they have all integrated, from searching for the oil, from getting to the oil, from making diesel, gasoline and other things out of the oil. Okay, so the business is getting more and more difficult. I will show you why. Because the oil is not an easy target anymore than it was in the past. So those companies have to invest a lot to get to the oil, to find the oil, and it's deep in the ground. And that's what you can see here in the cash flow statement. Exxon makes, that's Exxon here, what you can see here, makes $56 billion in cash average a year. That's a lot of money. And when you look now to the capital expenditure, so they invest 34 billion of the 56, that's 2/3 of their cash flow. And so they pay a lot for dividends and stock repurchase programs. But there is always something left. When you do the math, 56 minus 34, the 34 here, you get to 12 billion free cash flow. It's not great, but it's okay. So these businesses, they have to invest a lot. And you can see it in Chevron, even more extreme. I own Chevron, I still like it, but the business is getting more difficult, as it's also dependent, of course, of the price of oil. And look here, what do you have? You have 38 billion in cash flow, and you have investments of 30 billion. And so there's 8 billion left free cash flow. They paid 6 billion alone in dividends. So there is something left, but on a quarterly basis, if you look here, quarterly data, you have 5 billion in cash flows and you have an investment of 8 billion. So they overspend. They spend more than they make. Here you see there is 2 billion left. Here it's equal. 7 billion made, 7 billion spent, invested, reinvested into the business. So it's quite difficult to keep the balance of paying dividends, of repurchasing shares. Chevron purchase roughly every quarter for $1 billion shares. It pays 1.7 billion in dividends. So this here, you can call it financial engineering. That's how I see it. Dividends, and I think Warren Buffett likes both of those things. He likes dividends and share repurchase programs, but it has to be smart and he has to be balanced, and you buy then the stock when it's down and not when it's up. You buy more when it's down, and so you have to have a smart management to get this stuff here right. The share to repurchasing stocks and to pay dividends. So it's very difficult. There are companies that are very smart and they make a lot of cash and they don't have to invest so much. You see it in the old new economy, in those internet stocks, in those software stocks. Like if you look at Oracle, this IT software company that Larry Ellison runs, the stock is a phenomenon. I don't own it, but just look at this chart, at this long-term chart. The stock went up like more than 22,000% or so. It's just an amazing performance, and I am really, if you look at that thing, it's unbelievable. And so this guy, if you look at Oracle, is very smart in doing the right thing with aggressive repurchasing program. He buys back his stocks, he pays dividends, and it's an amazing chart when you go back in the 1980s where it started to be listed, or here on the chart you can see and it went up that much. It went up 20,000%. It's just amazing. Now look at the cash flow here. Net income of 10 billion yearly, or 11 billion, and 40%. The cash flow is 30 to 40% higher. That's a very good signal to me. So there is a nice distance. So he makes more cash than he is making income. That looks very solid. And look here, there's very little investment back into the business. So the free cash flow is just a monster. It's like 13 billion left. And so he buys back of the 30 billion, he buys back 9 billion of stocks, and he pays 1.4 billion in dividends on a yearly annual basis. That's an annual basis. And if you compare their companies, they are not good with this financial engineering. Like SAP, I own the stock. It's a great software company. But what I'm missing is here a nice dividend. I think it's too low. And what I'm missing also is stock repurchase programs. They don't do it that well. And I think they are missing here something. I think the signal to the market is not that good. They pay 1.7 billion in dividends, but they don't buy back any stocks. I think this is the wrong way. And I think SAP should learn from the American capitalism, from the smart way to bring the stock up, the earnings up. Is also, you have to have a balanced way, not just paying dividends. You also have to repurchase your stock when they are down, and they haven't done it. There were great opportunities in the past. If you look at that stock, I think Germans can learn a lot from Wall Street. I think a good stock in Germany that is doing it very well is the largest chemical company in the world. It's called BASF. It's a chemical company based close to the Frankfurt area. And if you look at it, they buy back their shares. It's a $97 billion corporation. And they're doing very fine with. They have a balanced approach of buying back the stock and paying a dividend, a nice, very nice dividend yield, and I like that a lot. Okay, that's all for today.